You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means it is Education Wednesday. Once again, and it's time for Options Bootcamp. This is actually episode dos of our live double header here, our live double Options Bootcamp extravaganza. If you like this, you like hearing this stuff, not waiting for a week for it to hit the podcast feed, you want to get it in your hot little ears right now, you know where to go, theoptionsinsider.com/plus or /pro. Either one of those will get you the access code to our members only server. You can tune in for this show, all the other shows we're doing here live here. So you don't have to wait for them to hit the podcast feed. And then, of course, you can ask questions. We just added some cool new wrinkles. You guys love your questions. There's a new contact method for our members here. So they get bumped. Your questions, your insights, your pearls of wisdom all get bumped to the top of the list out there. So check it out, theoptionsinsider.com/plus or /pro. If you want to see them both together, just go to /shop. It's all there. It explains it all. It's pretty cool, pretty straightforward. If you like your regular kind of on-demand, don't mind waiting a week out there, the podcast is still there, still ready and able for all of you out there. But if you like a little more, hence the name, Plus and Indeed Pro, you want to engage a little bit. You like the live streams, or perhaps you want to go pro and you love exclusive new shows that are coming out just for you. Options Oddities, more Q&As. There's crazy pro Q&As going on there. Then check out the pro there as well. Really cool stuff. theoptioninsider.com/shop explains it all for you. And of course, my name, Mark Longo, from the aforementioned website, as well as from the ever exciting network out there. You know what else is exciting? It's Market Taker Mentoring, where I find this little guy known as the black-hatted one, a.k.a. Mr. P, a.k.a. Dan Passarelli. Mr. P, welcome back to Options Bootcamp, part 2 of our double header. Are you ready to tackle some Qs, sir?
I'm ready. Let's do it, Mark. Let's freaking do it.
Let's freaking do it, indeed. You guys are just deluging us from all over the world. Let's see how many we can get to. It is time for a mail call palooza.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. We got a ton of these. We got to get to them. First, I know, Dan, your listeners have been beating down a path to your door. We don't want to exclude them as well. I say your listeners. Your clients, your mentees have been deluging you with questions. What's really resonating with you? What's the hot, cool, maybe made you think question that you got this week, sir?
Well, Mark, let me tell you. I am going to tell you right now. So I got an email this morning from Phil, and he had a question and a comment. Which one do you think I should do first? Comment's shorter.
With the comments about me and how dashingly good looking I am, then by all means, have at it.
It is about you, Mark. He says, P.S. Tell Mark that you need a raise and your own show on the network.
Oh, what would the Dan P show be? Just slamming crypto options all week long. How about that?
Well, I don't know, Mark. We'll have to talk about that. We'll see.
We'll call it the musical options show. You can play a riff, then talk about buying a call. How about that?
Exactly. When the music stops, we take one of your puts away. Wait. Okay, so here is the question, though, and this is a good one. This is actually a really great question. He says, I'm selling deep in the money put spreads for nearly the entire width of the spread. For example, the June 11th Apple 135, 130 put spread, and collecting $4.90 on every spread. And for a lotto ticket each week, we're looking to see outside positive moves that will decrease the value of the spread, say $4, where I can buy it back and collect the 90 cents difference. So, however, very commonly I'm being assigned days and sometimes weeks before the contract expires. The risk seems minimal, and as many of the contracts are just closed, my account goes into deficit status until the next trading day, but it seems not to have an overall effect. Can you explain? Am I missing something? Tell me. So look, my response to Phil, because this is a great question, I love what he's doing here, is to consider the synthetics, right? So if you're selling a deep in the money put credit spread, that's synthetically equivalent to buying an out of the money call debit spread. Your risk and reward is effectively the same. You need the same things to happen for you to make the same amount of money with either of them. But the advantages to the out of the monies are twofold, at least twofold. One is that you don't have to worry about this assignment because they're not in the money yet. If they end up in the money, then, it was a big win and you'll take it off probably before you get assigned. Plus, calls don't get assigned as easily as puts. And then the other thing is the deep in the monies probably have wider bid-ask spreads. And so if you're using the synthetic equivalent out of the money version, you're getting tighter bid-ask spreads. So you're probably losing less in slippage. You probably end up making a lot more money in the long run. So always consider that, especially when you're looking at trading in the monies for whatever reason, consider the alternative of the synthetic equivalent, because there are definitely a lot of times where you just might end up with a much better trade.
Now, it's funny you should mention deep in the money put spreads. We got a similar question here from Victor, or if he's European, it's Victor. It's American, it's Victor, W. I touched on this on Options Oddities last week because it was so relevant to there, but he actually sent it into boot camp. So I want to make sure I touch it here as well. So let's jump down to this one really quick. Victor says, guys, I really like your show. 5 stars. I have listened to all the episodes of Options Boot Camp, and the knowledge I have gained thanks to you made me a profitable trader. This has transformed, easy for me to say, this has transformed my life, ! Well, thank you for that, Victor/Victor out there. I'm glad to see so many of you are really thriving out here in these markets. He goes on to say, I was looking at live options flow today and noticed a trade I did not understand. So hoping you can demystify it for me. On May 14th, in the last hour of trading, someone sold the May 343, expiring on that same day, the 14th, 343 Amazon put spreads. He said he bought 3220 puts, sold 3260 puts. He says collecting 1.2 million in premium. Amazon closed at 3222.90, which means the trader got assigned 34,300 shares of the company. Seems like they lost 1.27 million on the trade. This one baffles me. Was the trader expecting the stock to end closer to 3260 and keep the premium? Can you explain to me, was this a stock entry mechanism or rather a fat-fingered order entry? Thank you and keep up the good work. Well, we dug up some of these trades for you on Options Oddities last week. We found them. It was a 200 lot, looked like, of the May 3220, 3260. You got the strikes right there, expiring on the 14th. And so it's a $40 put spread. Looks like they did it for $35 here. Victor/Victor. They sold the 3260 puts for $40.50, bought the 3220 puts for $5.50. So they did it net for $35. So you know right away it's a $40 put spread. The risk is only $5. So you talk about the 1.27 million out there. If given where it went out there on your trade, they actually ended up only losing couple of bucks on this trade because the stock went out, where was it? 32, almost 32.23, right? So they ended up going out with a couple of bucks against, I think it was 210 along that level. So 210 times your 200 trades. That's effectively what we're looking at here, Victor. So not quite the crazy madness. Now, of course, they did it in the money leg. So that makes things a little bit crazier because you're talking really they sold the 32.60 put for 35 bucks at that point because the 32.20 put went out worthless. So that put went out at about, looks like 37.10 or so. And so that they sold it for 35 bucks. So they lost 210. So that's basically another way you could look at it there. So the craziness about it, and I don't have it in front of me, but we broke it down on Options Oddities because there's a stock component now. They probably got, I couldn't see anywhere where they closed it out. So it looks like they may have gotten assigned on these. So they got some stock. Now the next day on that Monday, the stock rallied almost 50 points. So it was kind of the best case scenario for them. They lost a little bit of money on the options, but then they made a whole bunch more on the stock the very next Monday. So this was kind of a weird one. And you're right. We're starting to see more of these kind of funky in the money type spreads going up, but definitely wasn't a fat fingered type trade. I think they were just looking to what our other listener was trying to do, trying to get a wide in the money kind of put spread and get it off and try to play the angles there, Dan, and try to make that $5 or really that 35 bucks, keep as much of it as they can. Is there your takeaway as well there, Dan? Are you starting to see more of these in the money put spreads go up with your clients as well?
No, not with our clients. We haven't really been seeing a lot of these, but yeah, definitely not a fat finger trade. Like, listen, nobody fat fingers a trade for this much money and just, says, oh, it looks like a fat finger that. I guess I'll just leave it on and hope it works out, So definitely not a mistake. But I don't know. I mean, just a really key takeaway is, but by the way, Mark, I missed for a second. Did you say that you determined whether this was opening or closing?
The trade itself was opening. Yeah, I couldn't see if they came back and closed at the end of the day. There was no trade like that. So they never closed it out. They just did it for a quick one-day spread. Yeah.
So, you never know exactly what they're doing. Who knows? They could have done this against a different spread in, Costco or something like that. Could have been, like you said, a way into the stock with a long put for protection. I think it's very useful to look at unusual activity. You can glean a lot from it if you're good with it and you do all your homework. But, don't ever think that just because somebody's doing something in big size, you should do the exact same thing because you don't know their motivation and they might not even be a good trader, they might be, or they might be a good trader, but they just might be wrong. So, I always like to caution people about, jumping in blindly, but I do look at this stuff too. So look at it, but trade your own stuff.
Yeah, I don't know how much data or signal really there was in the noise of this spread. I don't read a lot into this one. It's not the same as someone coming in and buying 80,000, out of the money calls with a day to go and near them, something like that. That's a little bit different. I have the numbers here. I finally found them here. So the stock went out. He obviously 42 grand on the spread, but then the stock went out the next Monday. Again, he sold that put spread for 35 bucks. So he effectively bought the stock for 32.25 and the stock rallied to 32.70 that next Monday. So the 42 grand he lost on the options pales in compared to the nearly $1 million, 900,000 he made on the stock, which he probably kept unless he dumped it in the after hours. He probably had. So that's probably more how I would look at that one there, Victor. We can go on more about these. We got so many other people chiming in like this one, Dan. Okay, buckle in for this one, Dan. This one is epic. We thought Austin on the last show was good. This one takes it to the next level. This comes from the Planck. And he spells it kind of like Max Planck. Maybe he's a physicist. He says, hey, Mark and Dan P. It was just three short months ago, I discovered the power of options. Wow, he is a newcomer. A lot of people in your boat there, Planck. He said, I actually thought I invented the bull call spread strategy after I started playing around with calls and put P&L graphs. He says, ignorance is bliss. I want to share with you my recent story. I listened to the first 60 options bootcamp episodes. Wow, that's commitment. Well done, the Planck. And after having heard so many people write in about wanting to become professional traders, I am here to tell you, in all caps, it can be done. And done by listening only to Options Bootcamp. Wow. He says, I have just begun as a trader in Amsterdam after going through many interviews. failing several along the way. But despite my experience level of 0, I was finally hired. Oh, I was right. He is a physicist, hence the plank. Yes. My background in physics got my foot in the door, but the company that hired me placed me more of an emphasis on actual options knowledge rather than intense mental math, probability, Python programming, and brain teasers. Your listeners should know the only way to get a professional trading job is to practice these things over and over again. I never heard you guys mention these things that are the actual skills required to become a professional trader, but it is simply the way that it is. Your background means very little. They just want smart people. And he says the first several rounds of interviews are just online tests for every company, all of which are very similar. Make sure you know the market making game, understand Black-Scholes. Otherwise, options trading is a black box. In summary, 3 resources in 3 months got me from nothing to a job at a trading desk in Amsterdam. 70% options bootcamp. 20% optionsstrat.com. Not familiar with them, but he said he used them to visualize the P&L. Not perfect, he says, but it's a good way to help visualize the graphs. I think optionseducation.org is another place you can go for that. The OCC, they have all those P&L diagrams for you. 10% making sure I understand the Black-Scholes equation. I know you guys don't want to intimidate people out of the subject, and radio isn't great for math, but in the hundreds of hours of OIRN I've listened to, I've only heard in passing what is actually required a few vague times. Options bootcamp and Black-Scholes. Having said that all, I really got through the grueling interview process, you like this, Dan, by passing off Dan P's quotes as my own. Like, quote, your best projection on that strategy is barring your windows, unless you'll be jumping out of them soon. Anyway, since I owe you guys my entire future earnings potential, let me know if you're ever in Amsterdam and I will owe you a beer. Well, that's just awesome to hear there. The plank. And man, you really went from 0 to 100 very quickly. Good to see there are still a lot of trading desks. I know Amsterdam, people don't know about this, but the Dutch have always had a strong crossover with options trading. There were a lot of Dutch firms on the floor when I was down there, even here in Chicago. So they have a storied history of trading options. So I'm glad to see there's still some firms out there banging away at it. I'm glad to see you dove in with the knowledge you learned on Options Bootcamp, and also, Dan, by a few well-worn quotes from Mr. P. What do you have to say here for the plank who went pro in 3 months just listening to our show, sir?
Wow. Well, I mean, the most important thing to say is that all those quotes are copyrighted. So look, man, you're going to be hearing from my lawyer. No, I'm just kidding. You can steal my quotes all day long. Hey, that's pretty great, though, man. That's really interesting that you were able to do that. How humbling and interesting. Let's just throw a little disclaimer for our lawyers here, Mark, that past performance is not indicative of future results. So, it might take you more than 3 months of boot camp before you're a professional trader. All right.
That's a pretty fast runway. I do agree. That is a pretty fast acceleration. He just discovered options 3 months ago. Now he's doing it professionally. That's amazing. And that's just kind of indicative of the world we're living in right now. But seriously, Austin, the plank, all you others out there who are, in this case, actually making a living doing this. That's just fantastic. I love to see it all. So happy for all of you out there. You don't need to go to 0 or 100 as quickly as the plank did. You don't need to make this your full-time career. But certainly, it can help augment what you're doing out there in the marketplace. At the very least, help insulate you from some of these massive shocks. If the market sells off another 10, 20, 30%, you don't have to ride it all the way down. You can use options to insulate yourself, help improve your returns. A lot of things you can do out there. All right, Dan, these are just epic. We got so many epic ones here on the show here. Let's go to Mario Bermudez. Another epic one. He says, hello, I love your show and listen to it on a daily basis. Well, not so much bootcamp. I think you must mean all the shows on the network. He says, I'm currently trading SPX 0 days to expiration credit vertical spreads. I was wondering if you could talk about this strategy and what you know about it on one of your episodes. And as we always like to see, he did follow up with more details, which we like. He says, it first attracted me to this strategy. I got tired of speculating and being on the buy side of options. I would always buy out of the money options to try to get them cheaper and hope that the price would go up. Most of the times I would lose most or all of my money. I decided to look into being on the seller side of things and letting theta work for me. And also I wanted a more consistent trade with a higher percentage probability of success. When I do SPX 0 day to expiration option strategies is this. I look at the market sentiment, see if we're bullish or bearish. At the end of the day, that way I can decide if I want to sell a put credit spread or a call credit spread. Once I decide that, I look at the estimated move, see how much is expected to move. So today, the estimated move is about 15 points. So I usually spell the spreads a little bit further than that. So he's looking at the money straddle, pretty much, listeners, and selling his credit spreads beyond that. So he's getting effectively the beyond the one standard deviation move out there. I look for 5 wide spreads that I can sell at 50 cents. I do this every Monday, Wednesday, and Friday on the same day of expiration. I wait 5 to 30 minutes after the bell opens to pick my spread, and then either close the spread early at a dime or let it expire if it really went my way. I also do it on iron condors. I was about to say, it sounds like you're doing effectively your own kind of made-up iron condor strategy. He says I do that too. My goal has been to sell 10 contracts at 50 cents each 3 times a week. So that's a profit of $1,500 a week before commission. So Dan, it sounds like he's kind of created his own mini kind of iron condor selling strategy. Using the straddle as a gauge is not the worst way to go. A lot of people do that. I know Brian on his OPR show, for example, whenever he's setting up his skip strikes, flies, and things around earnings, he always looks at the money straddle and then kind of goes a little bit beyond that. So that's not a bad way to go if you are going to do this strategy. The time frame, maybe we could take some discussion about. What are your thoughts here in general on the notion of selling 0 days to go expiration spreads, and then B, some of the other caveats he has there about doing it for 50 cents, doing it outside the bounds of the money straddle and all the other stuff, Dan?
Yeah, I mean, this is definitely like a real niche strategy. And, look, I find that with niche strategies, the more you trade them, the better you get at them. And, this has some nuance to it. This is one of these that, if it hasn't happened yet, this is Mario, right? Let's see here. Mario, if it hasn't happened yet, Mario, like, just know like that this is the kind of thing that can blow up in your face, and you might say, oh no, but I'll adjust, I'll take it off, I'll cut my loss. But, like crazy stuff happens where like flash crashes happen and the market's down 1,000 points in 60 seconds, So like that's the big risk of this trade, that you make $1,500 a week for 6 months and then one day you lose $40,000, right? So if it's working for you, keep doing it. But just appreciate all the risks, look at all the nuances, keep getting better and better at it. Keep looking for ways to defend your position for those times when something crazy might happen. And so far, great job. So far, great job.
Yeah, the way he structured it with the straddle, I'm okay with. You're right, though. He says wide, and I don't know what he means by wide. That could be the issue. Depends on how wide these spreads are. If you're talking, 20, 30 handles, that could go against you. So I would definitely, if you are going to do these 0 days expiration, I would not let them go out. Even if they're going to go out worthless, I would close them out for whatever you can, a nickel, a dime. It's worth it in the long run, because in the after hours, when some of these crazy things could happen, and next thing you know, all of a sudden, maybe you're getting hit on the spread you didn't think you were. And all of a sudden, you're through your short strike because something crazy happened in the after hours. Remember, you have a few hours after expiration. People can still put in their exercise orders. So if the underlying's moving, there's a big announcement, we're going to war in the Middle East, whatever it is, you don't want to get caught holding that bag for that last nickel or dime. So I know it's going to erode your profits a little bit, but probably in the long run, you're going to thank me that that's a better way to go. I would like to know how wide you're talking to, because if it's many, many handles, like 50 cents, then yeah, I'd be a little bit cautious about this. But it's, at least you're learning and you're doing it, or not doing it naked. I like that. But that spread, remember, that spread is your risk. So how wide is it is my question. And then also look to take it off whenever you can. Here's one from IBKR22. I wonder what broker he uses, Dan. He wants to know, just checking to see if you guys have been trading it up, easy for me to say, during this meme-a-palooza. Seems like there are a lot of opportunities on the board. Love the show. Well, Dan, it is kind of a meme-a-palooza we're in right now. Every day it's a new name popping off like crazy. You mentioned one of your trades from earlier this week. I think I was on Clover. So what else have you been trading up out there, sir?
I mean, while we've been on the podcast here, Mark, I multitasked a little bit because QS showed up on my scanner, and that one's been an interesting one to watch today. So
if you're ever wondering why Dan sounds distracted when I toss to him, it's because he's trading it up in the background while we're doing the show. See, I'm committed. Mark, I miss my trades to help you folks. Dan's like, the hell with it. I'm just slinging, baby.
But yeah, QS showed up on my short squeeze scanner, and full caveat, by the way, with these short squeezes on a scanner, like the whole game is most of them don't work out. All right. So it's all about, having a tight stop and being okay, losing some dimes, losing some quarters, and then making a bunch of dollars, one out of every 15 times or something. It's sort of the opposite strategy of what we just talked about of the guy who was, trying to make pennies on a really wide SPY spread, right? So, we'll see what happens. Hopefully this QS trade works out as well as the Clover one that showed up on my scanner worked as well. But that's what I'm putting on right now. I just put it on within the last 10 minutes.
I'm actually mad at myself. I missed so many trades. So I'm doing so many shows, listeners. I had heard the rumblings about a potential takeover for WWE. I was planning to put on a bullish risk reversal in WWE. I got busy, didn't. Stocks up almost 20% today. So I missed that one as well. These are the prices I literally pay to do the shows for you folks out there listening. But yeah, there has been a lot of cool stuff popping off. If you're diligent, if you're smart, you do it in a risk mitigated fashion. There are a lot of great things you could do. I had this conversation again. If you're a pro member, check out the pro Q&A we just did with Henry Schwartz, the Flow Master, yesterday. We talked about this exact topic. It's funny when these markets go crazy, when they go nuts, it's a great time to go old school. And what I mean by that is a lot of the old school strategies can work you don't have to go crazy. And let the markets go crazy. You don't have to go crazy. So, but I mean old school strategies, verticals, and a lot of these names that are getting bid up to high heaven. Could be a Ford, could be an AMC. Pick your name. Clover the other day changes every day. Maybe WWE today. Those verticals are looking very attractive. So if you like that move, you want to get in ahead of it. I think there has more to do. You want to get these verticals at levels you probably can't get them otherwise. That's a great way to do it. Another thing, the old school butterfly. That's another kind of leg on the vertical, much more risk mitigated from that perspective. You're selling two, which is nice. So if you have these skews that are getting bid out of control, you can mitigate and make sure you target the selling of two right where the bid is the most aggressive. So you can set up these flies very nicely. Given how much things are moving around these days, I've had it happen a number of times now. You can get flies filled for even money, for nothing. You're just paying commission. So now you're getting effectively free flyers in a lot of these names. So that's kind of what I've been doing. AMC is one of those. I tried a few others I've mentioned on the option oddities. Sometimes they get filled. Sometimes they don't. Sometimes I have the temerity of paying a nickel to get them done. But still, there are a lot of great, very cheap opportunities you can get out there. One thing you don't want to do is go out there naked blasting away on units. I know Matt was kind of half joking about that on our pro Q&A last week. Ask him about the AMC to the upside. That shot up pretty quickly. So you don't want to have naked short units on these bad boys. You want to do risk mitigated strat. That's why I say verticals. That's why I say butterflies. You know exactly when you get into them how much you can make, how much you could lose. It's all very straightforward. If you just start blasting away on the wings, another thing, covered calls. If you have the underlying, if you do own AMC, I think we had a listener recently say he had the stock from like 14 and he sold a covered call for like $39 on AMC. That's great. That's awesome. There's literally no way you could lose on that trade. You're good. So that's amazing. So stuff like that also works. So keep it simple in these environments. Don't have to go nuts with all this craziness. But yeah, there are things, if you're diligent, if you understand what we've been talking about on this show for a long time, basic strategies, verticals, flies, covered calls, these things are all paying off right now. So pay attention to those. They've been working out pretty well out there. All right, let's be nice, Dan. Let's do one more for the folks, even though I know we're coming up against. Let's go to a quicker one. Maybe not that quick. This comes from Big Tim. I just like the handle. Big Tim. Big Tim wants to know, when is it better to leg into a position versus putting it on outright? So Dan, I know you like putting on your trades usually, up at the outset of the trade, put it out the whole spread on. But when do you like to leg into something, sir?
Well, when it's part of a plan to, like, there was this one trade that we did at our mastermind in 2019, real money trade with a small group of our traders, of our students. And it was in Beyond Meat. And I bought these puts. John and I crafted it together, with our students. And I bought these puts, and it both on the 6-month daily candle chart as well as the short-term chart. Like, we really planned it out nicely. And the trade just worked like a charm, made a bunch of money on Beyond Meat. And then what I did is I sold some puts to make a debit put spread. And I sold the puts at the lower strike puts for more than I originally bought the original puts. So I legged into a situation where the worst case that could happen is I make a little bit of money. And then the best case is I end up with an even more leverage profit if it goes right to the strike. So situations like that are one scenario. When I want to do an iron condor, but one of the sides is just too cheap to sell, I might do the one side and then do the other side later if it moves in that direction. Those are a couple great examples.
Those are both good. I agree with both of those. I tend to avoid legging into things unless I have to. Usually the time I would do it would be something like, I call them the inertia trades, like Dan kind of just pointed out. You have a trade you put on, maybe a single leg trade, and it really goes your way. And then maybe for some reason you don't want to take it off yet, but you could sell something else against it. Dan mentioned selling the put spread. Maybe you have a long call and you explode to the upside instead of taking that call off. You still want to keep a little bit of the upside. Maybe you sell a farther out of the money call, which is still extremely juicy against it. So legging into those types of inertia trades I like doing, but setting up a trade with the plan to leg into it, not usually the case. And maybe sometimes some of those wing spreads like the condor and stuff, but usually I don't do that. I know the Rock Lobster over there on the boot camp, he likes to leg into things like risk reversal. His mind won't let him buy the call. He'll sell the put, and then he'll see what happens. And if it starts moving, he'll buy the call. Obviously, there's risks to that. You can risk missing out on the move, but I like to do it more together. But hey, there are times people like to leg into things. For me, really, the only time I like to do is pretty much when the thing is moving in your favor. And for some reason, you don't want to take off that exact option. You want to sell something else against. That, to me, is when it makes the most sense. All right, great question. You can probably go for another hour on these. Maybe we will. Just so many of you out there. Glad to see, just again, so many of you out there have been listening to the show, getting a lot of value out of going back to the earliest days of the show, which is fantastic. Been mainlining it. Maybe you're like Austin, you're starting to trade now with real money. Maybe you're like the Plank and you took it to 11 and became a pro trader. Congratulations to you, the Prank, or maybe you're probably somewhere in between those two. Whatever it is that you're doing with this show, we're just so happy all of you are getting value out of it. We're so proud of all of you for really going beyond what we're seeing out there in the news, people just throwing money away at upside calls and losing it all. You are the folks that are learning. You are the folks that are trading options the right way. And guess what? You're going to be around 6 months, a year, 2 years, 10 years from now versus a lot of these other folks who are going to throw their money away on AMC upside and be done. So I'm glad to see so many of you out there getting a lot of value from it. Keep it up. We love to hear from all of you from all over the world. And before we go, Mr. P, if folks are intrigued, maybe they want to take their stuff to the next level over there at MTM. Where should they go? What should they do?
Make your way over to markettaker.com. Anyone who has interest in our upcoming mastermind this fall, it's kind of a select elite group of 4 to 6 traders per session. We trade together live real money in Chicago in the financial district. That's this fall. And if that sounds like something that you feel you're ready for, go to our website, scroll down to the footer and fill out the link to book a strategy session. And our trader success team will talk to you about the mastermind and see if it's a good fit for both of us. And if it is, maybe we can trade together this fall.
There you go. You know where to go. Market Takers. Don't be like me and forget the T. Market Takers, 2T.com. Market Taker. Easier for me to say. Market Taker, no S. MarketTaker.com. 2 T's is the place to go to learn all about that and a whole bunch more on behalf of the Black-Hatted One, Andy, myself. Again, we love you all out there. As much as you guys send love our way, it goes back tenfold out to all of you folks out there. Keep trading it up. Go slow. If you're not ready to ramp it up to 100, don't worry. That's what this show is for. Listen to it on your own time. Enjoy it. And then slowly progress. Maybe start with paper trading. Then you go up to do your first trade. Maybe not a calendar, but maybe some of you like that. And then you can keep going. Maybe, who knows? Maybe someday you'll be on a trading desk just like the Plank. And we'll see you back here next week for another fun-filled options extravaganza known as Options Bootcamp.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.